Hit record. There we go. There we go.
You bring an invaluable amount of resources to real estate investors, property management companies, owners, and I would say in many default cases, probably residents as well. And it has been I caught myself the other day saying it's been a wild 3 to 4 months. And I was like, it's been a wild 3 to 4 years. And so for those of you who don't know, we've got Jay Cummings from People's Trust. Jay has long been a professional in this arena. And one of the things I love about People's Trust is I think you guys are large enough to have horsepower to bring great lending options to people, yet you're nimble enough and the size enough that every time we've talked, I've sensed the level of creativity in the financing. And Jay, I really, really appreciate that because everybody cut me off in a second. What is interesting is we hear the national news talking about rates, challenges in Vermont. I think we've got inventory challenges. The other thing, though, right now is I've seen more creative opportunities in the last year and a half than I've probably seen in the last 10 years combined. And I think that's a product of the pressure on the marketplace, the rates, the inventory, and thinking out of the box. But I'm going to try to do what I have trouble doing and cork it right now. Angela, Jay, what are you guys thinking? Let's talk about, creative ways, financing, and so forth.
Well, I just want to give another plug for Jay and People's Trust Company. I mean, that feels like that local bank, and that lending to the person versus just purely numbers on paper, and lending to the relationship, which I think we've lost as a lot of our local community banks have been swept up by sort of larger entities. And I think, Brian, you're right. People's Trust sort of retains that lending horsepower, but with sort of a old school look at lending. So Jay, please step in at any time and give us maybe a rundown of what People's Trust has available, like what tools are out there for folks as they're looking for investment opportunities.
Yeah, I'm not sure. First of all, thank you both for inviting me to be here today. And I'm not sure I can improve on what the two of you already mentioned. But I certainly appreciate that. And what you mentioned is very true of how this bank performs and operates. We are small enough that we know your name and we look at the intimate details. We don't blow anybody off. We want every single sale that we can get, and we look at everything, right? So but we do have, we're not a giant bank. We're about 400 million in asset size. And I don't think there's been a deal that we haven't been able to figure out due to size or anything else. If it gets really monstrous big, we do our participation loan with another larger institution. In fact, that's worked so well that they've actually sought us out on deals that they wanted to participate in. So it's really, every bank has their legal lending limit, and this is how we've gotten creative to get around and look at some of those $20 and $30 million projects. The vast majority of our customers are looking at, a fourplex, 8s, 10s, 12s, and those types of things. And kind of another interesting twist on this of my belief in investment property is I've owned a couple in the past myself. I had 2 commercial properties that I think were 1, 2, 3, 4 units between the two. So I've actually walked in the boots of the investment property owner because I can empathize and understand that a lot more than just on paper. Back to People's Trust Company, I think one of the great things that, and I don't know about any specifics or any details about your business. I know prior to coming to the bank 10 years ago, I ran my own company for over 20. And one of the things that made us successful is I was able to control the process of all the services that we did from the customer from the beginning to the end. So the customer walked in the door, they did the sales, we did the inventory, we did the art, we did the production, we didn't have to send things out. People's Trust Company, everything that you get from us is done and performed. The task is done by a People's Trust Company staff member in one of our 5 branches. I think primarily there's 2 main headquarters in St. Albans that houses all of the underwriters. We do all of that, all the processing, the servicing, everything that you do is done by a People's Trust Company employee right here in the community. Locally, that kind of means a lot because we know how we interact with our prospects and customers. We're going to see them in the grocery store. We're going to see them at the school and stuff. So we take our time and we're very methodical in everything we do. And again, we want these to win for everyone. So that's kind of how we approach that. And I would challenge you folks, if there is any other financial institution that operates as in the manner that we do, our CEO has a desk in the lobby, and you can go to our main headquarters on Kingman Street, walk in the front door, take 5 steps, turn right. There's the CEO. He's not hiding behind his desk in the back room, or there's no gatekeeper in front of him. So that tells you that every person in the bank that is performing a job with a customer has to do it right and as close to perfect as we can, because if somebody's unhappy, they just walk in and talk to Tom, and Tom's going to have that conversation with them. So he keeps lobby hours as a CEO. So that really puts it out there of, you know, there's a level of professionalism and customer service that I think is unmatched. I look at our complete team, as I mentioned, from the processors, underwriters, servicing, and all of that. And I think I would put our team up against anyone. I know these people, and they are very, very smart. I thought I was a smart guy when I came here, and then I realized how dumb I really was until I learned how complex and dedicated the banking world is. So I've learned a lot there.
And Jay, if folks are looking to get into investment properties or start down that path, what are things that they should know leading into that process? What kinds of information should they have? Like, what should they be thinking about?
Yeah, so that's kind of an open-ended question. And I think if
Yes.
they've never done it themselves, they should seriously consider getting into it. As I noted in the seminar in person last night, 90% of all millionaires made their money in CRE, and 100% of all billionaires made their billions in CRE. So if money is of interest to you, and it's not everybody's thing, but it's many people's thing, one of the vehicles to get there is investment property. And I believe it, our bank believes it. I know everyone on this call is supportive in that, but I've seen those results where at the end of the day, you can amass a small or large fortune by doing that. And, you know, there's a couple of big names in Vermont that started with zero, and they've got billions. So it can be done. It's not that difficult. Looking for those opportunities and educating yourself and talking to qualified realtors, qualified attorneys. You need a banker that is going to be on your side, because when everything lines up, it's time to take action. Now, on conventional commercial financing, our bank, you're going to need to bring 20% of a down payment. And we will go 20 years. Sometimes we'll look at a 25 if it makes sense. But one of the primary reasons for that, I think most people know, is that you can't get PMI on a commercial building. So, and PMI drops off at 20%. So that's where we are. I think some other institutions are 25. We've just gotten so good at CRE that we're comfortable at the 20, and we know what we're doing. We know how to get it done.
And you're talking that's primarily for 5 units and up, because if you're in that 1 to 4 unit range, it's considered residential property. You can finance it like more like a single family home.
So that's where things get a little, I hate to come on here and to try to provide information, but then give you well, it depends.
Well, I mean, I'm a lawyer. I live in it depends land.
You're a banker. You know, so there's a lot of depends. My $1 million line of credit is going to depend on a few things, and Angela's going to have some open-ended questions to help make sure I answer questions correctly. Yeah. But no, great question, Angela. And Jay, appreciate your humor and joking with us, and the challenge of answering questions on a format like this, when in reality, because I'm a former mortgage loan officer, it's a Rubik's Cube.
That's a great way to put it. Some general guidelines, right? I would recommend, now you can get a commercial mortgage on a single family house if you want. And sometimes that makes sense for people. There's a variety of reasons of why that may or may not make sense. Typically, you might run down a residential mortgage product, and that's going to be perfectly fine for you. You get to the duplex. Okay. Now, if the down payment is a big hurdle for you on that first one, and a lot of people it is, You can get into an FHA loan if you live in one half, rent out the other. That is one of, and quite possibly the best way to dip your toe in the water and get started. And most people that do that, I've got a few customers, I think we mentioned it last night. I've got 2 customers in the last year and a half to 3 years that went so well. They were making some money renting. They were making money at their W-2 wage job. They went and moved on to a house, and now they're renting out both sides of the duplex. And now that profit really starts rolling, and then they save up that for the down payment on the next one. Yes, you can finance a triplex and a quadplex, a 3 and a 4 unit, using a residential product. The challenge is the fees, the LLPAs, low level pricing adjustments for Fannie Mae. So when you go to somebody, and when I see somebody on a 3 and a 4, I automatically start with a commercial product. And then you say 20% down, and they're like, oh man, 80 G's up front. That's going to be a pinch for me. Okay, well, let's look at a Fannie Mae product and then you start getting those fees. And here's where, again, it's not always, but generally, this is good advice. If you had a hard time coming up with 20% down on a commercial loan, but you can get into the residential loan, but the LLPAs are like 25 grand, that's going to be a challenge too. So if that upfront money is sticky on that, where's that upfront money going? Now at closing, those LLPAs are going to Fannie Mae. Those don't come to us, right? That goes to Fannie Mae.
With acronyms, LLP, was that loan level price adjustments, or
yeah. Sorry,
basically a way to say you're making money. We're taking a little bit more of a risk. Louis and Vinny like a little extra.
Yeah, that's what Fannie Mae does. Now, Fannie Mae is an organization that is built on a basis of every person in America deserves to have a home, a place to put their head on a pillow. And that's why they have the lowest rate in the residential industry. And they kind of venture outside of that core message and core product to do some of these other things like investment properties. The entire banking world is run on risk, as you alluded to, Brian. And in the Fannie Mae world, I'm assuming that when you get into investment properties, the risk goes up a little bit for them and they adjust that accordingly. But the point being made here is those fees go to Fannie Mae and then whoosh, they're gone. At least with a commercial product, you're putting money down and you're lowering the principal amount owed. So that's really, if it's 50 grand down, even though you've paid that in advance, that's still equity in your pocket, right? Because now at closing, you owe 80% of appraised value versus at closing with a residential product, if it had 25 grand of fees attached to it, you still owe 95% of that debt back, right? So it is a little uncomfortable on those first ones, or the first one, that 20% down. But it just seems to work. And
Jay, I think that's a really important point and a really important thing for folks to consider when they're looking at those numbers is the lower number isn't always the better for you financially. I mean, that comparison is stark, right? You get 20% equity by that large payment versus 5% equity and a huge amount of the money you're paying going to your third party servicer. That's a big deal. That's a big difference.
Absolutely. And sometimes and we see it in all industries, people tend to get hung up on certain things that they think are important. And then later on, they're like, oh, I didn't have a full understanding, or I wasn't thinking long-term on that.
So I will jump in and say this is why it's important to get sort of your professionals lined up before you think about going into this field or doing these kinds of transactions, getting your banker squared away, having these conversations with your financial advisor. If you don't have a financial advisor, it's probably good to find one and start working with someone. Real estate attorney, like you want to get these folks lined up because they have experience, they have knowledge, they have a broader scope and can bring value to you and information to help you make better choices.
And I would add to that, as you're assembling your team, make sure they're experienced and passionate in real estate investment, and show that they have the passion to check the nuances. And Jay, 2 things came to mind when we were speaking. if I remember correctly, one of the great things about the Federal Housing Administration is they basically require to live there as a primary residence for 1 year, and then they can leave it behind. So if they live a year, that like a lot of people say to me when I was more front lines in real estate, I don't know if I want to live next to my tenants, but I would ask, could you live there a year so that you can actually provide your family with wealth building opportunity that rarely can be matched? The second thing that comes to mind about on the commercial side, if I remember correctly, you have the potential of being, depending upon your underwriters, your bank's appetite, a little bit more creative in, is it held by an LLC? Is it held by an individual? And where's there cross collateralization opportunities? Whereas if I have an apartment building with a lot of equity, I may not have the 20% down, but your bank might be willing, under certain criteria, to look at a cross collateralization so that I can extract some value out of my current properties to add to my family's portfolio.
Absolutely. That is an excellent point, Brian, about that building equity, because most people, almost every one of my customers, once they get in that first one and they get comfortable, there's a lot of uncertainty. And then they're looking at the mailbox on the first of the month, where's that check? And I need to make that payment to the bank on the 10th. And if it's late and stuff like that, after they get a year, 18 months, they're like, all right, the 95% of the stuff I worried about, I don't even need to worry about. And the 5%, whatever it was, it didn't happen anyway, or it wasn't a big scary deal. Like,
Oh, did Jay freeze?
We got Zoom.
Oh no.
Yeah, it's been, I had one a little bit funkier. And thank you for our participants and anybody listening, because this is the modern day technology that we complain about, but 10 years ago, we barely had to enjoy.
We didn't even have it or didn't use it. If anybody has any questions, please feel free to pop them down into the Q&A for Brian or myself or Jay, assuming we can get him unfrozen. He may have to leave and come back, go out.
Yeah,
and come back in.
don't hesitate to. This is the modern day world. So I'll pick up a little bit from just my knowledge of being a lender too. Is one of the great things that Jay is talking about is, for example, when my first amazing wife, I've been blessed with two, first amazing wife, rest her soul, we did a lot on 15s and 20s. Now on amortizations, great. We were building, great to have you back. Great. And I was just mentioning, first wife and I did a lot of 15s and 20s. Great. We were on a forced march to build a lot of savings and equity and have a cash revenue machine in 15, 20 years. Now, one challenge I'm facing, this is where People's Trust can help, is we've got a couple paid off buildings that are going to be nearing their depreciation cycle. So I might have the opportunity to 1031 or talk with Jay, pull out either a line of credit or cross collateralization, keep the apartment buildings that I have, and then go out and find something else that's not going to only add more revenue, more appreciation, but also more depreciation.
Absolutely. Yeah, that's what I, as the people get to those third and fourth properties, now it's a machine, and now they're manufacturing production, and they will just want to scale up. So yeah, getting to the equity that you've already amassed is it almost becomes autopilot, right? As those first down payments were difficult, now the properties are growing on their own. We've got a lot of different ways to look at a lot of different things. Sometimes we can get you access to money on a property without an appraisal. We've got some parameters. I can't remember those off the top of my head. I know in the residential land, we'll do combined loan to value 60% on your tax bill. Right. So if you don't need an appraisal and you need a certain portion of that, I know in the commercial, there's some dollar amount limits to that and whatever the percentages are, but you wouldn't be able to go in and grab 100% of it. But if you only needed 50% on the duplex and we got the tax bill and we check out the debt on it, you could have access to some very fast money very quickly without having to get the appraisal, which is expensive and takes time. That, for me, on my side of the street, I see the appraisal as the slowest part of the entire process, is waiting for that, especially with commercial buildings. Finding comps is quite a challenge.
Jay, are there other things that maybe look a little different on the commercial side from, say, a standard residential mortgage, inspections required, things that lenders generally require on the commercial side that maybe aren't required on the residential side, and sort of vice versa, just in case people aren't familiar with those products?
So I think the biggest one is and you mentioned it last night at the workshop about the fire and safety has to go in and get a clear bill of health.
Right.
Other than that, we're not really, we'll look at the appraisal. I don't believe we look at the building inspection. I think the appraisal gets us as far in the weeds as we need to get. Other than that, top of my mind, I can't think of anything. But again, the beauty with us is we'll look at everything a multitude of ways. And when an applicant comes to us, it's really digging through their history or whatever that's in front of us to find that pearl that we can bring over the finish line and get it done. So I would tell people to not be discouraged. And sometimes even if you get a no once, that's more on buying businesses and things and startups as it is on CRE. CRE is just so easy to do, and we do so much of it, and we're so good at it that it's almost a machine for us to get it through. Everybody knows what they're doing.
And for folks that might not be familiar with the acronym, CRE is commercial real estate. So
Yeah, sorry about that.
that's okay. I do it all the time.
Yeah,
Same.
one thing that does come up frequently, depending on who's watching this and their level of experience in the industry, I guess one of the let's talk about some of the differences between the two, right? So people say, what's the rate? What's the rate? What's the rate? Well, no bank publishes commercial loan rates. I think we've got about 75 of them on our internal page because it goes under it depends, right? So with comparison to residential, you go right on the loan page and you see it down to it seems like the 100th%, and you lock in, and all these things start triggering a timer of they've got to get this document to them at a certain time, and then this, and it's very stressful. It's very regulated and really locked down. And it's quite a different process than getting a commercial loan. And the commercial loans are so much different. One other point before I get back to the rates, typically when you buy a residential house and you go in for a residential loan, single family, a line's drawn in the sand at the moment that you apply, what's your W-2 income, and that's it. Whereas with a commercial property, or if somebody's buying a business, you're allowed to use projections. And projections could increase your debt to income ratio. And a lot of what banks do are ratios, loan to value and debt to income. So you do have that ability if there's a property you're looking at and rent rolls are way underpriced, and you can prove that to the underwriter. It doesn't have to be, you have to prove it to the underwriter, a reasonable amount of certainty, right? Not like you need leases signed, but if they've got all the tools like insurance companies have, and they know what the risks are and the chances of things happening on all the formats, and they see duplexes in this area are renting at $1,400 a month a unit, and you're buying something at $9,000. I mean, that's a steal, right? You can afford to buy that at a 5 capitalization rate, because as soon as you go in there and you put the rents to where they're going to be in this market, that 5 cap might turn into a 10 or a 12 for you. So that's a steal and a half if you can find those. You will be able to use those as future revenue as projections. So that sometimes helps quite a bit. But back to rates, as much as they kind of sound like they're negotiable and stuff, and they kind of are, because you're negotiating the risk of the borrower and the strength of the borrower and the quality of the asset that you're buying, right? So there's a little bit of room there for interpretation. So, but what we do is somebody comes in and they want to look at a property. Nothing's made up in the back room, and there's not people just voting on that. Banks are heavily regulated, and we have auditors coming in, and they're looking at all, 1 out of 3 loans are evaluated for fairness and things like that. So what I like to do is somebody comes in and we have a general idea of where their risk rating and strengths are, and we've kind of got their ratio set up. Then we go look into the file, and say, what's the lowest rate recently that we've given somebody that has the pretty much identical ratios and credit quality as this person? And then you can justify that rate. So then everybody is actually being treated fair and equitable and that. So it's not published on any website, but it is fair. Like if all three of us went for a loan and came to People's Trust Company and all of our financial strengths and everything was equal, in all likelihood, we would all receive pretty much the exact same rate on the loan. So it is quite fair. It is checked over. So there's no sweethearts deals. There's no other people paying more. Everyone gets fair and equitable treatment. We just go right as low as we dare to go with everybody that we can do to make that deal happen. A couple of other things that people might want to be aware of, and it causes some trepidation until you get into it and you've done it. Like I mentioned before, most commercial loans are 20 years. But the number of years that you're locked into is going to change that interest rate a lot more than almost anything else that's discussed on that application, right? So most of my customers opt to go for what I call the 520. The loan is amortized for 20 years, but we lock that rate for 5. And then at the anniversary of that, then we renew at whatever the market rate is. It's kind of like going to the restaurant and ordering the lobster roll over at the North Hero House. It says market rate, because it fluctuates so much. I've had one customer in my 10 years here that said, I want the 20, I want the 20, I want the 20. And let's say that the 5-year rate was 4.5 and the 20, I'm making this up, but the 20 was 8. And she just said, I want to put my head on the pillow for 20 years and I want to know that that rate's never going to go up. But when rates go down, you can always refinance, right? So my thing is, if rates are going to go up at the end of 5 years, pay the higher interest rate on the next 5, not on the 10, the 5 that you just did. Because when the interest rate's lower, you're going to chew down that principal quicker. And then again, to Brian's point, that equity gap is going to grow and you're going to have more access to more equity to do apartment 2, 3, and 4. So, and unfortunately, in this case, the lady that did the 20-year, she ended up selling the property at 4. So she could have easily have done the 5 anyway. But I don't have a crystal ball. I didn't know that she was going to move to Florida in 4 years, but she sold the business, sold the property. So typically, most everybody opts for that 520. And again, it causes a little bit of heartburn in the beginning. But after people do it and they've done it for years, they get more comfortable with it. I also talked quickly about capitalization rates. And that's basically how much money gross that you're making on a property without including the mortgage and the interest. So that way you can compare how much money you're going to make on an apartment compared to other apartments. And the rationale for that is when you're trying to establish a value of a property, whether or not you need to borrow doesn't impact the value of that property.
Mm-hmm.
So if you need to borrow money, it doesn't make the property worth less. And if you don't need to borrow money, it's not worth more. So that's how they do those calculations with the capitalization rates on that. So, yeah, I forgot where I was going to go on that. I'm sure it was a very important point.
I have a question for you on capitalization rates.
Sure.
What are you seeing in your primary areas for capitalization rates on commercial real estate versus heavily residential? I know, for example, in Burlington, we're seeing on duplexes probably 5.5, maybe 6. In some cases, we're seeing 6, 6.5 on multis. Yet you go to a more of an emerging market, such as in Washington County, I think you're going to see some 8s and 9s. Franklin County, I'm not as up on these days, but I bet some 7 or 8s. So that's something people should consider too when they're looking for where they want to place their money.
Yeah, those numbers are very in line of what I would have said. Franklin County is in the 7 and 8s, and Burlington is below 6, and it's a tight market. And it's kind of funny. I not that I'm a genius and I can predict things, but I saw about 5 years. Pardon?
We'll say you are for today.
Yeah, hey, why not, right?
Well,
Um,
we are recording it so we could check back in like 5 years and just
right.
see. Right.
Well, we need a time machine to go back, because 5 years ago, I started seeing people that had a lot of cash starting to buy investment property. And back then, when it was a 9 and a 10 cap, they were like, yeah, no problem. And it got below 9 in St. Albans, and they were still buying them because they knew inflation was coming, and
Mhm.
they knew one of the best ways to guard their dollars from devaluating. And that $4 loaf of bread is going to be $5 next year. Put it in real estate. So they were buying everything that they could get their hands on, knowing that was a great way to protect their cash or for the devaluating of currency long term. So I saw in St. Albans what was happening is Burlington investment property owners were coming here, and while our people were kind of saying, "Oh man, I don't think I'm ready to pay an 8 or a 7.5 cap rate," the folks in Burlington were coming back and they were like, "Man, that's a bargain," and they were hopping all over it. And then and real estate continued to grow in value. So now those eights are probably back up to 10s and 11s for the owner. They're not looking to sell them anymore. But because of things have increased, rents have gone up. They're doing great.
Yeah, and as a side note, what comes to mind when we think about capitalization rate is two different things. One is, some people may be looking for cash flow, in which case they're probably going to focus a little bit more on Franklin County or Washington County than the heart of Chittenden County. Whereas if they're looking for liquidity, and I would argue liquidity is going to be strong in all three because the inventory is so low. But I know it's in Burlington, to sell a building or rent it out is a little bit more like shooting fish in the barrel. So personally, I'm seeing a little bit lower rates there, which makes sense if you want something more liquid.
Mhm.
Um, Talk to us if you can. What are you seeing? Like what I find interesting is in the last year and a half, 2 years, I've seen more owner financing opportunities that I've probably seen in the last 5 to 10 put together, which is extremely interesting considering the rate environment. Now, some of that is full first mortgages, but a lot of that is seller seconds. Can you talk to us a little bit about how you at People's Trust approaches seller seconds, combined loan to values, CLTV, stuff like that?
Yeah, on the owner financing, I probably can't speak to much detail on that. I can't remember, maybe I get one deal a year that involves that, and sometimes we end up getting cut out altogether. Uh, the, you know, Owner financing scares me a little bit. Many times when that happens, it happens much more often when somebody's selling a business. And let's say the business is being sold for $350,000, and I do a lot of business valuations myself for sellers and buyers. And we come up and say, geez, this thing's really worth about 175 or 200. So we're not going to be able to approve you for the 350. And then they go back and they tell the seller, I couldn't get approved from the bank, and they would only loan me 200. And they're like, hey, I'll loan you the 350. And then they find out a year later they've overpaid for it. And there's other calculations that need to be taken in consideration. I think the one thing, Brian, that might be close to the owner financing seconds is, people come up and they're a new investment property owner and they don't have the cash. They'll get some money from family, and as long as it's a gift and we have mom and dad write off we're gonna loan Jimmy and Jill 50 grand to go towards this investment property, and they just sign a paper saying, and we don't expect or want to be paid back, and you can treat it as a one-time gift. That's a way to help bridge that financing gap and we do see that a lot. It's funny, there are some young kids that are very aggressive and very driven, and they're focused that they want to make a huge fortune or name for themselves, and they're getting it done, and I love seeing that.
Yeah, it's truly, in my opinion, one of the last few remaining areas that you know individuals that from a variety of economic backgrounds can make tremendous wealth. As far as with people's, are you pretty flexible? Like with some of the secondary market products, and I can't remember which one, Fannie Mae or Freddie Mac, may have a requirement that Brian's been managing properties before to use some of the rental income. How much does People Trust look at the experience of the individual buying the property with either CRE or property management experience Or is that really a case by case basis based upon loan to value, credit bureaus, reserves, and so forth?
Yeah, I would say in that case, Brian, again, everything is measured on risk. And the simple fact that you've done property 1 and 2 successfully yourself alleviates a lot of the risk for us on property number 3. So that's really going to come into play. What's also going to come into play is if we think we can win you over by financing you on property 3, we got a better shot at number 4. That'll play a factor also. So we just we love this market. We love this product in this industry and the people that want to get it done. And we just feel if we can get one person to the finish line, they're going to want to do more. And
Absolutely.
I'm not on commission for anything, so there's no incentive for me to offer you any different type of product that may or may not make the bank more. And for me, yeah, if I'm sitting with you and we're trying to get this fourplex financed and done, yeah, I want this deal. If I don't give you the perfect deal that you love, you may think it's great right now, but a year from now, when reality sets in, you're going to know what's what. And you might say, yeah, Jay got me over the finish line, but maybe there was another avenue he could have looked at that saved me a little bit more money or whatever. Not only do I want your business on that first deal, I want you so happy a year later that you're recommending me to your friends, to your family, and to everybody because I took great care of you. I do a few things that I don't think any banker does. There's no strings attached when you talk to Jay. I'll talk to you anywhere, anytime. I give people my cell phone nights and weekends. Financing can be complicated. Investment property can be complicated. I don't want you awake at night over the weekend because you don't have access to me. So I give people my cell phone. If you can text me a quick question, I give you a nice reassuring answer. You get to enjoy the rest of your weekend. And that's not a problem for me. Maybe it comes from me being self-employed for 20 years. They call me the farmer around here because I work so many hours. But I just want you happy. And I want, that's for me, business success is making you so happy that you're going to refer everybody else to me and make that happen. I'll go walk properties.
So I was going to say, I heard you offer to walk properties last night at the seminar. So
Yeah, it's not a replacement for a property inspection, but on a first set of eyes, I spent a life in construction as a kid and out of college. I can look at some stuff and say, you might want to have a second look at that furnace. This chimney looks a little scary to me. That roof, ooh, boy, that might be nearing its life cycle. So I can tag a few of the big items to advise you to look at further scrutiny. I'll run the projections with you, right? I'll help you any way I can. Because the one thing, and I see it a lot, I keep going off commercial real estate and into businesses, is as I see people buying these moderately small businesses, and then a year from the day, they realize that they've overpaid, and that's when reality sets in. So for me, having any customer 1 day into their loan or 365 days in the loan, if it's not a good fit for them, it's not a good fit for me or People's Trust Company. I want this to work for you. I want you to make a bunch of money, and I want you to do it multiple times over. And I can't think of anything else I can do but all the things that I do to help people. And I never tell people yes or no. I just say there's this avenue and this consideration, and what does this mean to you, and how would you handle this? And you should be concerned with this, and this looks pretty good.
I love it. I also think when you talk about, like, if it's a year into it, I've seen people get as many properties under as many long-term mortgages as you can, because you get more properties out there appreciating. I was more focused on lesser properties, but getting them paid off more quickly. So we had a couple economic engines, spitting a lot of cash, and it's in progress. So I think it's great because of the creativity, because I also know if I did it over again, I'd do more of a mix of the two. Oddly enough, question for you, maybe selfish, you guys do mobile home parks?
Like a full trailer park?
Full trailer park.
Oh, I would love to do. You know of one for sale?
We should talk. We should definitely talk. Which is, I think the other thing you guys are helping doing, and Angela knows this, is the people that we're talking to are really, are really helping our communities either provide housing or, keep up small businesses. And so I think, well, I doubt the inventory challenge will change anytime soon. And then there's a question for you too. You know, working with a bank like yours that sees that as the value of the community, I think is absolutely huge. Which, segueing into the question, have you seen S100 bring any value to people's trusts, consumers, in creating more housing yet?
Not yet. I'm cautiously optimistic that it will. Oddly enough, I got invited to sit on this. I'm not sure what you call it, a consortium. There's probably a dozen, 15 of us. 8 regions in Vermont were given grants from the Federal Bank of Boston to study something significant for Vermont. We selected housing as our challenge. A few other people picked poverty or some other forms in those areas. So I was shocked by the results of that. And that's kind of why I'm even more, not that I needed more motivation and fire to get out and do more development, get my people to do more developments. But we had a housing needs assessment done for Franklin and Grand Isle County. And as of the year 2020, and this is, we're knocking on the door of 24 because of the census, Franklin County and Grand Isle County were behind 3,350 doors, which means if, miraculously tomorrow there were 3,000 houses, they'd be filled instantly, whatever the time it took to pay for the, to get a loan for those and buy them. We still wouldn't have satisfied the current demand. Right. There's a bunch in there that are homeless. The vast majority of people, and I think that number is either side of 6,000, are what's called challenged or distressed housing. These are people paying 40, 50, and 60% of their income, of their paycheck, towards housing. There's a neighborhood down the road from where I grew up that I saw a duplex for rent for 1,800 plus utilities. And this was a place that not long ago, that was 800 or 900. So these folks are in there probably close to 2,300 a month with their utilities and their rent, trying to make that housing work for them. Right. That's a good house payment. Right. So those folks are never going to get to the point to be able to buy a house for themselves. And
Jay, one of the things that has happened is HUD, when they're doing their rent, setting their rent limits for Section 8 and sort of subsidized housing, is they've lumped Franklin County in with Chittenden County. So they view St. Albans and Franklin County as an extension of Chittenden County. And so they'll pay Chittenden County rents up in Franklin County. So that's what's happening, is you're seeing that bump because of that designation.
Yeah. Bad for the tenant, good for the landlord.
Yeah.
And that has kind of, again, forced prices up. I personally feel that if there was one thing to kind of point the finger at of how we got here, there's a lot of state and local regulations that slow down development. Or prevent it in its entirety. And maybe some of those things 40 years ago were put in place in an attempt to help something. But I think now that people have doubled their housing costs, is a much bigger issue at hand. These people are struggling, and I just don't see.
And it makes it too expensive to develop the units, either just across the board or to develop them and offer them at an affordable rate.
Absolutely. Absolutely. So I've got a recommendation into our committee that I think will help. I probably can't say too much about it right now, but I can tell you that if the committee doesn't adopt it, our bank's going to look and see if they can do a portion of it. And it's basically helping properties get developed in our county. There are areas that the municipalities are like, hey, we think something would go there, and that would be pretty easy to get that up and approved and developed. And everybody's kind of changing their tunes, municipality, regulators, developers of banks and stuff. What can we do to add some more housing? Because, you turn on your news channel of choice, it doesn't matter left, right, center, up, down, everything's a crisis because they want you to pay attention to it, and they get paid on clicks and volume, not on accuracy. I do think that in the housing situation, at least in the state of Vermont, crisis is appropriate. There's a lot of folks that are struggling, and that is the biggest nut that they're trying to cover.
So I'm wondering if there's room in the private lending world to mirror or mimic the Vermont Housing Investment Program, the VHIP program that the state was launching out, where they were giving grants. I mean, banks couldn't do grants, but you could definitely do lower reduced interest loans, $30,000 to $50,000 per unit for rehab of units, to sort of bring them up to code compliance. The state program had some restrictions on who you could rent to after that, and sort of keeping rents at an affordable level. But, I'm just wondering if there's room in the private lending field to develop some sort of product along those lines, that would go towards increasing and improving housing stock. The demand, I mean, that program oversold. Like, they had so much interest in it and so many requests for it, like the money was gone like immediately.
Yeah, I had heard that, but I had also heard that Franklin County was a little bit on the light side of that. So there may be some opportunities in Franklin County for that money.
Yep.
They've also put a lot of attention on the ADU, the accessory dwelling unit.
Yep.
That hasn't gotten the traction that they thought it was going to have. And I think it sounds great on the surface.
Right.
One of the challenges are, if that person's in a property that can have an ADU built on it, but do they have the mindset to run a business and to be a
Right.
landlord? Maybe they do, maybe they don't. And the challenge is you might be forcing someone to go through that ADU, and maybe they're not good with running a business and being a landlord, but now they rely on that rent to make, to be able to satisfy their own bills. And if that blows up, you could have somebody that previously had a house have no house because they got bounced out of their own. So I
Right.
think there's some, and not everybody wants to come to our seminars and
Right.
our
Yeah, you also tied into what can we do to better help educate everybody, but not only providing, 3, or so organizations here working together to promote the viability of this, at the same time, with humor, we've got to also educate ourselves and take those opportunities. What's interesting too, you made me think of is, excuse me, People's Trust could be a great ally. If I'm taking a mixed use property, could there be more units put on that unit? Like, for example, I'm thinking of 2 properties side by side in Burlington where they may be able to actually add units, and your institution might be able to help with the financing side of that. Yeah, I think there's a very interesting time. And, I read an article years ago, I think it was Santa Barbara, California, or Sacramento. You could make $250,000 a year and still qualify for Section 8 assistance. So let's hope that Vermont's not going to become that, because I appreciate that program. I just would hope we didn't need to earn up to $250,000 to benefit from it, because that's a housing issue.
Let's hope we don't see that anytime soon. That's a lot of money to do on housing. And that's what, as we try to become more efficient, to get more doors online, to help more people, help developers. I've got a couple of people now that had bought previously fourplexes in St. Albans. The lot's a little bit bigger, and they're getting permits to add another duplex or a fourplex on that. You already own the land, it's paid for.
Yeah.
We've got an interesting product. I know we've got one on the residential side, and I'm sure we could work something out on the commercial side. So we've got, obviously you guys are familiar with the home equity, but you need to have the equity in the home to get access to it.
Yep.
Right.
We've got the term escapes me right now, like a renovation loan, where we're able to give you the home equity in advance based upon the future value of the addition to the property. And the whole point that we came up with that is, we all know people that have locked into 30-year mortgages in the low 2s. The last thing they want to do is disrupt that. That would be dumb information for me to tell somebody, yeah, refinance and go to 7. No, if you got something below, 3.5, I mean, I can't imagine a situation where you should ever disrupt that, right? That's as close to free money as you can. So you leave that there. We don't touch that. but then you want to build that garage. We find out the garage is going to add $80,000 value to that property. And then we give you the renovation loan to do that as if it's like a reverse HELOC almost type of thing. So I'm sure in the commercial that there's got to be a way to make that work for you. And then, you know, Brian, I'm sure you've said this 100 times, and when you play in the residential land is, you know, you date the rate and you marry the real estate. So
yep. And if you got cash, you talk price, and if you don't have cash, you talk terms. So as we're rounding out the last few minutes, I want to ask the toughest question of all, and just really see if we can help you break a sweat for this last few minutes.
Should I turn the recording off? Is that
No,
what
I
I'm
think we're
hearing?
good on this one. You know, it's just we'll be able to leverage it maybe with Jay down the line. What's People's Trust forecast for rates for the next 3 to 6 months?
That's a tough one. I'm not even sure if we even issue a forecast. That might be the type of thing where I mentioned earlier, you go down to Kingman Street and walk in the door and turn right, especially on Fridays, and talk to Tom. What I'm hearing in the industry is that Fed probably aren't going to be raising rates anymore. A couple months ago, the Fed was talking about lowering, looking at reducing that in Q1. So so I can't speak on behalf of the bank. In fact, anything I said here tonight is just on my personal opinion of things.
Yeah.
There's my disclosure. Where's the asterisk for us bankers?
I used to know as a loan officer, in the absence of change, rates will remain the same. You know, and so it was half serious, half joke. So thank you.
Yeah. My sense is the rates have peaked.
For the record, I think we're pretty close to that point. I think the other challenge too is we've had my first 2 weeks in the business, started off as a loan officer, rates went from 9.5% to 10%. Everybody was freaking out, and I was so ignorant, wet behind the ears. I asked them at least twice to explain why, and I didn't understand. And with humor, I wouldn't be on this, call today or Zoom today had I understood. We need to be a better professional. So part of what our challenge is weaning people off aggressively low and historically low rates to what is average. Now, the one thing I see in the multifamily market, particularly in Burlington, is it's the people who are looking to go out finance rates at 7.5, 7.75 on a 5.5 or 6% cap are going to be in negative amortization unless they put a significant amount of cash down and or are buying it to offset their taxes. Because depending on what they do, they may or may not be able to use depreciation in a different fashion.
Exactly.
Angela,
any final comments or questions from you as we round out our hour?
I don't think so. Assuming this goes up and goes live, then we can share it to the masses. I would say keep your eyes peeled. I know Jay and I are going to be bringing another seminar in 2024, probably February, live in person. I know Brian and I have been talking about bringing these seminars back to in person, sort of switching it up a little bit. So
I think it's a great idea.
Yeah.
It's time.
If there's any collaboration on our part, we'd love to help you. I do have a lot of experience with those going over the 100 sessions, so I'm more than happy to show you what I did, help you out, whatever you need.
Awesome.
With that note, I'd like to say thank you to you and your organization for doing what you guys do to help Vermonters further their goals, including wealth building as well as providing housing, both things that we need. And Angela, I can't stress enough, thank you for all that you do, because you are on the road to sainthood, because I know it's looking forward to an interesting legal update sometime soon of everything that we're dealing with.
Yeah.
Love to also thank Rosie for making everything happen. And again, my name is Brian Armstrong, CEO of Strongwell Property Management, KW Vermont. Thanks everybody for listening, and hopefully we can help you further your goals and creating opportunities, both to provide housing as well as wealth building.
All right. Thanks everyone.
All right.
Take care, folks.
Guys.
Thanks, Jay.
Thank you.